My view is that we're probably going faster into recession than anybody expects, and probably much deeper. I think that's coming. I think we've got a replay of 1974 underway, which was the ISM the Institute of Supply Managers survey, which is a good guide to the business cycle, went from 56 to 30 in 4 months. Similar setup with oil prices screaming higher, supply restrictions, rates going up, the Fed hiking, all of the same stuff. And there's several of these in history. Equities don't like it generally. The bond market tends to turn earlier, which I've been waiting for, and bonds have started rallying to say, you know what, things have gone too far. I still think we probably have another leg lower in equities into the final low, much like we had in 2018 as well. So I'm not short equities. I've been buying bonds, and I've been buying kind of growth equities, all the stuff that's super beaten up, because I think that the cycle plays out faster than people imagine, and the outcome is a U-turn by the Fed. Yeah. This chart is mortgage rate of change of mortgage rates, 2-year rates, oil, gasoline, and the dollar.
Yeah, this is a good one.
Over the business cycle, it's suggesting we've just had the largest monetary tightening in history. Yeah, and that what they've done, the markets have done, because the Fed were barely involved. Yes, you're right, they're jawbone, but what they've done is cemented in the KK precipitous drop. As I said, that the last time we saw something like this was 1974, and it was over pretty quick. Now, it depends whether it's a quick thing or a longer thing. I think it's a quick thing. So as soon as the ISM approaches 50, they stop. Because obviously below that, you start seeing unemployment rising, other bits and pieces. So my guess is we get an ISM print of around 52 below consensus. And then by July, it's below 50. And so they're done. That's my view. I think it's done. I've got a lot of charts that look like this, but this made total sense because I've been saying that the increasing fixed cost, commodity prices, PPI, all of that stuff was going to destroy consumption, demand destruction. The dollar was always a problem because it went up quite fast at a rapid rate of change. And rates have gone up, 2-year rates and 1-year rates have gone up at the fastest rate of change in all of history. 1-year rates in the US have gone up 800%. And wow. People say, well, that doesn't matter because the rates are low. I was speaking to a good friend of mine last night, big family office, multi-billion-dollar family office. And he's like, oh yeah, we refinanced everything. And I'm seeing it with all my friends. Everybody who's refinanced their stuff is now seeing massive interest payment increases. That's the rise in the oil price, which is a tightening of conditions, the rise in gasoline, the rise in mortgage rates, the rise of 2-year yields, and the rise in the dollar. Now, the S&P 500 right now is pricing in an ISM of around 47, around recession level. It kind of suggests that it might need to come a bit lower, but it's against a good comp from next year, so it'll come lower anyway. So the year-on-year rate of change versus the ISM. So I don't know when this turns up, but as yields are turning now, oil, I think, breaks as it did every time we've had this setup. Oil breaks as well, then we're going to find that this chart will start hooking up and we can start looking forward. It feels like all of this is going to play out faster than anybody imagines. Faster downside, faster upside, I think. But, I don't know, because Urian's right. If we end up in this situation where inflation doesn't come down, I actually think it goes negative. But if it doesn't come down, then we've got a longer term issue that could be more of a bone crunching bear market. I looked at this separately and I tried to figure out what was the idiot proof method, because I'm a lazy macro guy and I'm not as talented as Urian in building models. So what I try to figure out is how can I model network effects in a reasonable way? And I did a lot of work on it and I found it was the two things together explained pretty much everything. It was the value exchanged, let's say on a weekly basis or monthly basis, you choose it, in dollar terms, multiplied by the number of active users. Now, the number output is not important. Just put it against the price. It's identical to price, and it doesn't have price in it. So it's telling us that the market is pretty efficient at pricing the network. Now, what you're saying is the network growth is the thing we're trying to estimate, right? Because then you've got the real value add. If you can forecast network growth, then you can basically forecast price. But I figured out how to value price. Market's bloody good at doing it. The only one that's traded somewhat differently, and it's too early to say, was ETH. It traded at a premium to that, and I think it's to do with the burning. mechanism that meant that we've got a slightly different supply structure. So I would probably have to model that out, but I'm not smart enough, but I'll figure out how to do it at some point. But it was the value. So if you think of Bitcoin exchanges more value each week than Ethereum does. Ethereum has a lot of transactions. It's a red herring. Transactions are a red herring. It's total value, a number of active wallets, and Bitcoin beats both. However, if you look at Ethereum, the change in values, the rate of change in those two values in Ethereum is higher, which is why Ethereum's been outperforming Bitcoin over the last few years, couple of years. And I found it's really useful. Listen, if you believe the future is in the technology, in blockchain technology, then this whole digital asset space should outperform the safe haven. That's just how things work. It always works that way. And therefore,
there's a higher beta.
There's a higher beta. And if you're in an exponential uptrend, because you're in a network adoption model for the entire space, not just for Bitcoin, then it should outperform over time. It's as simple as that. It's not a value statement about, I don't like Bitcoin because X and I prefer Ethereum for Y. It's all about network adoption models. Once you understand that, you free your mind of all of the narratives that are in the different buckets.